Fastpartner Q2? Not as bad as you think. Fastpartner's Q2 report looks mixed at first glance. Rental income is still down, occupancy is weaker than last year, and property values were marked down by more than 200 million kroner. So no, this was not a clean turnaround quarter. But it may also not be as bad as the headline suggests. Before the report, the market was not expecting perfection. Fastpartner had already disappointed in Q1. Rental income was under pressure, NOI had fallen, property management profit was weak, and the share price was trading close to low levels. So the real question was not, did Fastpartner suddenly recover? The question was simpler, did things keep getting worse, or did the company start to stabilize? This is where the quarter becomes more interesting. Q2 net operating income improved clearly versus Q1. The surplus ratio moved back up to 74.6%, and property management profit increased from 171 million kroner in Q1 to 209 million kroner in Q2. That matters, because for a Swedish property company, recurring property management profit is one of the most important signals. Not net income, not accounting noise, recurring earnings. The strongest interpretation is not that Fastpartner is suddenly fixed. It is that the low-bar bear case became harder to prove. The company showed better operating leverage. It protected the margin, and it gave investors more concrete leasing commentary than expected. Management said the Frihamnen vacancy connected to Nasdaq is in principle filled. That does not solve everything immediately, but it reduces the risk that a major vacancy becomes an open-ended problem. Still, the negatives are real. Rental income declined to 545.7 million kroner. Economic occupancy was 89.3%, down from 91.3% a year earlier. And the valuation mark was negative, mainly from Kista, Akalla, and Solna. That is why this is not a clean beat. If occupancy does not improve, and if rents from new leases come in weaker than expected, the report can still become a value trap instead of a turnaround signal. Fastpartner still has a major credibility test. The company wants to reach 1.2 billion kroner in rolling annual property management profit by the end of 2028. Right now, the rolling figure is around 790 million. So investors need a bridge. Where does the next 400 million come from? Leasing? Lower interest costs? Projects? Cost control? Occupancy recovery? The report repeats the target, but it does not fully prove it yet. Because there was no Q&A, investors did not get the usual chance to pressure test the details. That makes the next reports more important. Fastpartner needs to show that the Frihamnen backfill is not just space being filled, but rent that actually supports earnings. It needs to show that H&M, Magasin X, and other leasing discussions translate into cash flow. And it needs to show that Kista and Akalla were a contained reset, not the start of a longer valuation problem. Without that evidence, the quarter stays mixed. With it, this could become the first sign of stabilization. So the clean read is this. Fastpartner did not deliver a recovery quarter, but it did deliver a stabilization quarter. The operating print was better than feared. The margin was stronger, recurring profit improved, and the vacancy discussion became less negative. At the same time, rental income is still not growing, occupancy is still below where investors want it, and property values are still under pressure. That is why the report is mixed, but not necessarily bad. Fastpartner's Q2 is not a victory lap, but it is not a collapse either. It is a low-bar relief print, a quarter that says the company is not recovered yet, but it may be less broken than the market feared. And in a stock already trading at a large discount to reported NRV, that difference matters.